Hello and welcome to the How to Exit podcast. Today I'm here with Patrick Stroth. Patrick Stroth is a trusted authority on executive and transaction liability. His firm, Rubicon Mergers and Acquisitions Insurance Services, is a member of the Liberty Company Insurance Brokers, a nationwide network of insurance brokers focused on middle and low middle market companies. Patrick is a pioneer in applying rep and warranties insurance to lower middle market M&A transaction. He and his team are committed to help lower middle market owners, founders, and investors achieve a clean exit. Patrick is the host of M&A Masters Podcast, where he speaks with leading experts in mergers and acquisitions. Thank you for being on the show. So let's just jump right in with you. What got you started in M&A, like mergers and acquisitions?
Yeah, so I'm an insurance broker by trade, got out of college, went right into insurance and did everything from home and auto all the way through commercial insurance. I found a real passion for the complexity and just the intellectual challenges with executive liability. This is directors and officers liability, employment practices, professional liability, things like that. It's a lot more interesting than home and auto. I got pulled into mergers and acquisitions because one of my policyholders is a doctor, and this is about 5-6 years ago. He had 6 companies. He was bundling them together and he was selling them to a healthcare conglomerate for about $50 million. And I had asked the doctors were putting the insurance together just to, have it run off and so forth. I just said, so what are you going to do with the money? Where are you going, Doc? And he said, well, I'm going to the old country, which was Israel. So he was going to be, after the merger, after he sold his company, he was going to leave the country and go off to Israel. When the buyer found out that he was leaving the country, they changed the terms of the deal and they said, look, this isn't personal. We don't mean to be adversarial, but we got to hold back half the money, okay, for at least a year or two, because you know what? If you leave the country, we have no way of clawing the funds back. So I'm afraid we have to set this up. So they were going to hold back 25 of the $50 million in an escrow fund for, I think it was probably more than 2 years. And so the doctor came to me and said, Patrick, seriously, there's got to be a way we can insure this transaction. And I said, well, there is a way, but it's prohibitively expensive. And he just said, price is no object. And when a lot of clients in insurance tell you price is no object, they're sincere until they know the price. And then it's a really big object. And all of a sudden they said no. And when I saw that happen in real time, I pivoted the practice of our firm to add in this product called reps and warranties insurance. And essentially what it does, for those that may not know, it's probably the biggest thing in private equity today, but what it does is it steps in the shoes of the seller and enables the seller, who ordinarily they make a bunch of disclosures about their company to the buyer, and the buyer performs due diligence on the financials and the legal, et cetera. Just to see how accurate those disclosures, or what we call reps and warranties, are. And based on the buyer's diligence, they're going to go ahead and say, great, well, we're going to move forward and purchase your company. However, we can't diligence everything. So if something pops up that we didn't know about or you forgot to tell us, we've got a provision in here called the indemnification provision that allows us to claw back some or all of the money from the purchase, okay, if the discrepancy is big enough. And we want to be able to claw that back.
So this original product was for like larger deals. You were saying $100 million deals, and it's very common in that space.
Yes.
Right?
Yeah. It was reserved initially just for $100 million plus enterprise value deals. It has over the years come down to 75, then 50 million, then 30 million. And so, I mean, they're writing policies now for $25 million enterprise value deals. The challenge, though, is, if you're a private equity firm, are you going to spend, several $100,000 to $1 million to diligence a deal that's probably, 25 million? It's a lot easier. The bigger buyers have the leverage, so they can essentially tell the, and I've had clients come to me, sellers come to me saying, Patrick, we've heard of this rep and warranty. We'd love to do it. We'll pay for it. Tell the buyer we'll pay for it. Just, can we get it? And the buyer's just going to sit there and say, look, I'm sorry, it's cost prohibitive for us. We just can't do it. And so that's where there's been that gap until now.
In this case, what is the application process, or what is needed? Is there still audited financials and stuff, or what's the subset that a business owner would need to present?
That's a great question. I'll tell you, we're going to break it up between the TLP and the traditional. Okay, traditional rep and warranty. There's no application. Essentially, what the underwriters do is they want to get a draft copy of the purchase and sale agreement where there's a list of what the reps are. We then ask for the reports that the buyer had. What diligence reports? Did you do a quality of earnings report? Did you do a tax report? Human resources, legal diligence, all operational diligence, all those types of areas of focus that were performed. Okay, and then based on that, the underwriters will look at that and put out a proposal that says, okay, well, if we were to dive into this and really go through this, we figure a policy of X amount of coverage is going to cost Y amount of premium. And before we get into this, we're going to need to hire an outside counsel to look over the due diligence and actually vet it. Okay, that's called an underwriting fee. That underwriting fee is routinely between $35,000 and $60,000. So out the door on a traditional policy, you're going to be paying $30,000 to $60,000 just for the underwriters to go through their whole process. A traditional rep and warranty policy, the policyholder is the buyer. The intent of this rep and warranty is so the seller gets a clean exit. If the buyer suffers a loss, buyer goes to the insurance company to collect. Okay, so it is on a format called a buy-side policy. Under TLPE is what we call a sell-side policy. It is not dependent on the buyer's diligence at all. It is just dependent on the quality of the policyholder or the quality of the seller and their business. They review an application. They review the current financial statements of the seller. They would look at the letter of intent just to see just format on the structure of the deal, and then they will put out their terms. And the terms, this process, because it's finite, it's not going to cover every type of deal. The process is on an accelerated platform because the intent is underwriters want to write hundreds of these a month. And if you have a cumbersome multi-stage process for quoting and evaluating, it's not going to work. And so they wanted a streamlined process, and they've put together a process that, essentially that from beginning to end can take literally 2 days to get these things done. So it works out very, very nicely. You can burn up to the full purchase price on your attorneys that are going to be very expensive, and we're on the hook for it. We could lose the whole $5 million. Absolutely not. Deal died right there on that point because the bank wasn't going to back down, and the sellers were quite frankly like, we're not writing a blank check for you guys. Okay. Within a day, they had heard about us with the TLPE, reached out and said, is this possible? We were able within a couple of days to ensure the full $5 million value of the SAS. We put in a provision that it was simple. The bank had full authority to use whatever attorney they want. They could incur whatever legal costs up to the policy limit, which was $5 million. And they were set. All of a sudden, seller, the worst they were going to lose is $50,000. That was the deductible. That was it. Okay. Moved forward on the deal and got it taken care of. And those are the types of cases that we really like because we want to come in where a seller is very vulnerable and they've got nothing to hide, but they need to get this. And the buyer has a legit concern and they want to hedge their risk. And so how can we bring that product for both of them? And that's what TLPE does.